Oil traders were perhaps one of few groups in the energy business to benefit from the price crash in 2014, taking advantage of market volatility to bring in record-breaking profits during the downturn. The stabilizing oil price, a boon for the oil industry as a whole, impacted the profits of some of the world's largest independent oil traders. Gunvor Group, for example, saw its profits drop by 48% in 2017 as the oil price hovered near $70 per barrel. Vitol, the world's biggest independent oil trader, saw profits dip 25% in 2017 to $1.5 billion, from $2 billion in 2016. Though profits dipped, the overall volume traded has steadily increased. According to BP, global oil trade grew by 4.3%, or 2.8 million barrels per day, in 2017, compared to a 10-year average of 1.7%. Oil trade, as a share of global consumption, also reached record highs, climbing to 68.8%. Traders are gaining from the growing LNG trade, with Gunvor Group largely crediting its 20% increase in volume last year to its fast-growing LNG business. Combined, Trafigura, Vitol, Glencore and Gunvor traded about 27 million tons of LNG in 2017, nearly a 70% increase over 2016. With many African countries focusing on LNG portfolios, including Equatorial Guinea, Mozambique, Tanzania, Senegal, Nigeria and Angola, Africa is a prime spot for traders aiming to capitalize on the game-changing LNG market. And gas is far from the only opportunity for traders. Africa's severe lack of midstream and downstream infrastructure represents a real opportunity for traders seeking a profit and more control. Vitol, for example, in 2017 acquired Vivo Energy, a downstream joint venture with Helios Investment Partners that sells Shell-branded fuels at 2,000 filling stations in 15 countries. Vivo listed this year on the London Stock Exchange with a valuation of $2.7 billion, the largest Africa-focused IPO from any sector in more than 10 years. Africa's refineries, nearly all operating well below capacity, require significant investment to meet even current demand. Traders are also stepping in here. Glencore made headlines this year with its $1 billion takeover of the Chevron refinery in Cape Town, for example. And the continent is closely watching Nigeria, which has been seeking private investment to rehabilitate old refineries and build dozens of modular refineries. For countries with ample storage like South Africa, the drop in oil prices offered a chance to stock up on cheap petroleum. Saldanha Bay, which is currently able to hold as much as 45 million barrels, accounted for 9% of all seaborne traded oil in 2016. But South Africa represents one of very few ample storage centres in Africa. In general, the continent is severely lacking in storage capacity, both for refined and unrefined products. Traders have also stepped up as financiers for cash-strapped producers, playing a more prominent role in the upstream market, offering creative financing options from swaps to pre-financing to commodity pricing. Vitol, Glencore and Shell are in the running to acquire $1 billion in assets from Brazil-based Petrobras in Nigeria. These assets include 2 world-class fields with very low costs. Clearly, even in a less volatile market, traders are quick to identify the opportunities across the energy spectrum, adapting to market conditions to bridge the gap between African producers and consumers.